first of our sessions today is going to be around the approach to bond investing. And my first question, Darren, if I could start with you. Obviously, you're a fund manager. You look at these securities day in, day out. Have you ever found the perfect bond investment? Or if not, what would it look like to you?
Sure, I'm not sure there's ever anything such as the perfect bond investment. You only work out what those are in hindsight, having worked out that something's performed extremely well with a low level of volatility, a phrase I'm sure we'll talk about later. In terms of what makes an ideal bond investment, there's probably three things I'm looking for. So I want to be paid a reasonable rate of return for taking three risks. And the three risks will be, one, interest rate risk. And so that, how long will the bond be before it matures? What's the bond's maturity? The second risk is credit risk. If I'm investing in a corporate bond, how long before I receive my money back? What is the likelihood of me receiving my money back? What is the chance of default? And probably the third risk that's come into being, particularly recently, is this thing called liquidity risk. How easy is it for me to buy or sell bonds? Can I readily realise my bond should I choose to sell it? So the thing that would make an ideal investment is that, given those risks, that I'm paid a reasonable level of return for taking those risks.
And Jeremy, I just wonder, are there any other key features that you're looking out for? Obviously, you're a bond analyst, looking at a lot of these securities. Are there any other key features of bonds which you're looking at when you're doing your research on particular assets?
Yeah, I have to agree with what we've just said. I mean, the only other thing I would add is maybe we look at some of the structures of the deals to make sure that most people probably want plain vanilla. And I think if we're all aware that, especially with the retail investor, that bonds that sort of have an element of, or a complex, or have an element of some kind of interest rate derivative, is probably not something that we can actually market without having to make sure that people understand the product. And I'm sure we're all aware now that the word at the moment for fixed income investors within the fund management industry is suitability. So I think we take a step back always to look to see what the client's trying to achieve. And within the criteria we've just mentioned is to try and fit something around what they're looking to do. Now that could well be, as you say, if you can reduce the credit risk by going further up the high grade ladder, you can basically reduce your maturity. We'll talk about duration later, as we said. And the other thing to do, of course, is to make sure that you have access to the markets via your fund manager or the execution desk. Liquidity is an issue, I think, across the whole of the bond markets. But yes, the other things I would add is basically it's probably more suitability as well for the individual as opposed to just a plain vanilla investment strategy.
I mean, you both mention liquidity there. Obviously, one of the advantages of the retail investor platform, ORB, the London Stock Exchange platform, is the ability to trade live on a daily basis. How does that liquidity help in terms of approaching bond investment?
Well, it probably touches on one of Darren's key issues there, is can I readily remove the bond from my portfolio if one wishes to do so, if that cash is required for something else. So obviously that daily liquidity that's provided here is vital for retail bond investors up and down the country, particularly depending on the size of their portfolio.
And another area which investors obviously have to look at carefully when they're making bond investments is tax, essentially, because obviously if you have a coupon of 5% and you're paying a 40% tax rate, your actual tax after tax yield is 3%. So could you just talk over this idea of the tax equivalent yield, perhaps, and also some of the features of ORB specifically?
Yeah, sure. When you look at any bond that gives you a return, some of that return will be in the form of income, some of that will come in the form of capital gains or capital losses. So if you have a high coupon bond, and you can identify high coupon bonds because the price will be far in excess of 100 pence. If you have a high coupon bond, you're going to get more of your return in the form of income. Now the income is taxable. Alternatively, however, if you look at a low coupon bond where the price of the bond will be 100 or even below 100 pence, you're going to get most of your return in the form of capital gains. So if you're a high rate taxpayer, of course you want to take that into account, and of course your income is taxable, your capital gains are not. You may wish to bias your portfolio towards a lower coupon and below 100 pence in the pound bonds.
And the ORB platform bonds, I believe they're also available in an ISA. I mean, do these tax considerations, do they have an important role when investors are considering investing?
I think in these days when people are particularly looking for income within portfolios, let's not forget it's 6 years since interest rates were cut to practically 0%. People are looking for income within their portfolios, and so it does make sense that you would have a income producing asset such as these type of bonds within tax-free wrappers such as ISAs, SIPs and pensions, etc.
Jeremy, quite a long time ago, there used to be a theory in bond markets that you should never pay above par for a bond when in the kind of early days. I mean, how have things moved on since then, and how do you approach looking at the valuation of these assets?
It's interesting you say that, because the retail bonds are always priced at par, and I think it makes it easier for people to understand, because then they're looking at the coupon itself and not too concerned about the premium over par or the discount to par, as we were saying earlier. And also, talking about tax, I think one of the great innovations with the retail bond market has been the fact that it is par. They do trade above par, but most of the time people are looking for the income. As it now basically almost like people are all taking to looking at their own pension, making sure that their own pension is under their own. I suppose within their own auspices, and that's interesting from their point of view. They can look at the coupon, they can buy it. But the problem you have with what should we say, some of the longer, shorter dated gilts and treasury market, or what we would consider to be probably one of the higher grade, or I would like to say risk-free, but that's not necessarily the case anymore with the government bonds. But again, you have to make sure that people understand they will be paying over par, and it is historically still quite difficult for someone to pay 127 for a gilt and then realise that they're only getting a very, very small percentage back in terms of income. But we'll probably talk about diversity later, but it does offer you a certain amount of comfort versus a credit with a lower grade rating.
I mean, I don't know if I can jump in here, Will, but one of the features of bond markets in recent years has been that interest rates have fallen, and as interest rates have fallen, bonds that were issued many years ago were issued with high coupons. And those high coupons, if interest rates have fallen, they've become more valuable, so they've gone to premiums to par, as we call it, or to 100 pence. And so many of the old style bonds are priced quite highly, and it's really only the bonds that have been issued in recent years that have taken notice of the low interest rates. But there aren't too many bonds that are priced below 100, which is a real challenge for retail investors.
On that point, Darren, I think what in our industry and what we're doing in conjunction with the regulators and with the exchange itself is making sure that investors are more educated about that, so they do know the difference between YTM and income yield. So YTM obviously working out, discounting the premium that you're paying and giving you your best guess of your total return over the life hold of that bond. Obviously, those rates haven't changed for over 6 years now.
Absolutely. I mean, you mentioned YTM there, yield to maturity, and the bond market does have a lot of different ways of measuring yield, the return that you're going to receive through to maturity, etc. I mean, could you just talk through a few of those and perhaps which the better measures are for investors when they're thinking about what their returns are going to be?
Again, it comes down to largely to any investments of personal choice, as Jeremy and Darren have both highlighted what's right for the investor. But typically speaking, I personally find for my client base that the YTM is the best, is that they can indicate what they're going to get over the lifetime. So trying to do is very simply, if you paid par for something and the coupon was 5%, the YTM and income yield would both be 5%, depending on day one. But if you paid 102 and the coupon was 5%, your income yield would be 5%, and your YTM, your yield to maturity, would take into account the over 100 that you've paid, and you would get, just off the top of my head, around 2.8 or something like that on the YTM. So that means that you would earn 2.8% per annum until the maturity of that bond, discounting obviously any market volatility, which happens quite frequently these days.